Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is making offers like a pro. Rain Nation, let's talk about something that separates the hopeful investors from the real operators, making offers with confidence and clarity. Because if you're out there falling in love with houses, throwing out random numbers and hoping the seller says yes, you're not investing, you're gambling with better lighting. A pro offer isn't just a price. It's a strategy, it's protection, it's leverage, it's how you get deals without getting wrecked. Here are 5 reasons making offers like a pro matters. Number 1, it keeps emotion out of your numbers. Pros don't offer based on vibes, potential, or, but it's so cute. They offer based on the math. Comps, rehab, holding costs, and exit strategy. Emotion makes you overpay. Numbers keep you profitable. Number 2, it builds instant credibility with sellers and agents. A clean, confident offer with clear terms tells people you're serious. When you can explain why your offer is what it is without being defensive, you become the buyer they trust to close, not the buyer who disappears when inspections get messy. Number 3, it protects you with the right terms, not just the right price. Price is only one lever. Inspection periods, due diligence, closing timeline, financing contingencies, and appraisal language can make or break your deal. Pros structure offers so they can move fast and stay protected. Number 4, it gives you negotiation power without being a jerk. A pro doesn't lowball and ghost. A pro anchors with logic, uses comps, and negotiates like a business owner. Calm, clear, but firm. You can be kind, but still be savage with your boundaries. And number 5, it creates a repeatable system so you can scale. When your offer process is consistent, your buy box, your numbers, your terms, your follow-up, you stop reinventing the wheel every time. That's when you can do more deals faster with less stress and without needing a pep talk before every offer. So, Rain Nation, here's the badass bottom line. Pros don't wait until they feel ready. They get their criteria tight, run the numbers, structure the terms, and make the offer. You don't need to be the biggest buyer in the room. You just need the cleanest, clearest, and most confident closer. Now go out there and make your offer like the badass you are. Now on to today's episode of the Real Estate Investor Growth Network podcast. Today's guest is Matthew Riccadella, founder and CEO of Crystal View Capital, a private equity real estate firm specializing in value-add manufactured housing communities and self-storage. Matt has been in real estate for over 20 years, has been a principal in over $1 billion in transactions, and he currently oversees more than $650 million in assets across multiple funds. What I like about Matt is he's not out there selling hype or financial gymnastics. He's known for disciplined underwriting, operational execution, and true alignment with investors. His whole philosophy is simple fundamentals: buy right, operate well, and treat partners fairly. And Rain Nation, we're going to dig into why manufactured housing can be recession resilient, how to protect investor capital when markets get choppy, and what it really takes to create durable cash flow with upside. It's my pleasure to have him on the show. So welcome, Matthew Riccadella. Welcome, sir.
Well, thanks. Thanks for having me, Jen. I appreciate it.
They're going crazy for you.
Yeah, look at that, huh?
And I like your background. I did a bathroom recently with tile that looks like your background. So I love that. Very,
I'm in
very
the
cool.
bathroom right now.
I,
Bet you
I thought I heard flushing.
know.
So, Matt, I know we are limited on time today, and I have so many
Yeah.
important questions to ask you, but give us a little background on you. What pulled you into real estate in the first place?
Yeah, I started back in 2003 in real estate. I started flipping houses. Actually, I started as a realtor. And the way I built my business up was prospecting, direct cold calling, door knocking. And I did reasonably well. And one day I made a cold call to somebody and they asked me to buy their duplex. And this was a time when, I had no money, no credit, and figured out a way to come up with the cash through a bank loan, and ended up buying it and did really, really well. I think I made $350,000 profit like a year later. And then after that, I just decided not to go back to being a realtor and being an investor, and kind of built my career from there. And same concept of the direct outreach, building relationships with these owners. I went out, started flipping houses, and then I transitioned into commercial real estate because I was looking for passive income, and built up a pretty nice portfolio. The problem was I couldn't really get to the scale I wanted to get to, because I was always limited with my capital base. You had to sell something to buy something new. And at that point, I launched Crystal View Capital back in 2014 and started raising outside capital from other people, and did really, really well. And reputation spread, treated my investors like partners, as you mentioned, and really built a brand and a reputation. And went exceedingly well. And here we are today with our fourth fund.
Very cool. So, why Crystal View? What's the name about?
Yeah, so it's if you look at a crystal, which is our logo, it personifies transparency, so you could see through it. So there's, I think, everything in life is easier when it's kind of open, and that was the purpose for that brand, that logo, and that name.
I love that, Matt. Thanks for sharing that. I was very curious where the name came from. So I
Yeah.
want to dive in here and talk about manufactured homes. And this is something that has been on my radar now. And because there's such a need for affordable housing. And it seems like the manufactured homes, they are gorgeous now. Some of these new ones,
Yeah.
I'm like, oh my goodness, they have drywall, they don't have those panels anymore. So, why do you feel manufactured housing communities are recession resilient?
Well, when you think about affordable housing, as we think about it today, you have apartments, you've got single family residents, you have single family residents for rent, and costs continue to rise. Inflation runs hot. Interest rates are very high right now. It's very challenging for the average American family to find affordable housing, certainly to buy a home and own their own home. So, these costs continue to rise. And what we do is we own a subset of the affordable housing complex that is the most affordable of all of them. So that's why I think it's recession resilient. In fact, I think it does better in a down market. So to the extent that the economy suffers, inflation runs hot, people can't afford to buy a home, they can't afford to rent, our assets become more valuable because we receive even more demand from the marketplace looking to rent from us, looking to buy homes within our communities. So it's kind of like, think about it as a hedge against the rest of the economy to a certain extent.
Absolutely. So, question about manufactured home communities. Do you own the park or do you own the houses and the park? Like, what's the structure for you?
Yeah, we own the infrastructure and the dirt, and
Okay.
then the actual resident owns their own home for the most part, and then they rent the dirt from us. So they have a space. We maintain the roads, the infrastructure, the clubhouses, the streets, the utilities for the most part, and then they just pay lot rent. And then the actual home itself is their responsibility. So the sink clogs up, the toilet leaks, the ceilings leaking, that's their responsibility, part of their repair and maintenance. And that's what also makes this asset class quite compelling, certainly when you compare it to multifamily, because the landlord has to maintain the entire unit. All we're doing is maintaining the grounds. So margins are a lot wider in this property type.
I love that. And are most of them on septic systems? Do you have ones that are connected to city sewer and water? How does that work?
All of the above.
Okay.
Our preference is city utilities, because then it's the city's responsibility. But we do have some that are on private systems. So it's our well, our septic tanks, a lagoon system, treatment plant, whatever it may be. But the majority is city water and sewer.
And how do you find these properties?
Kind of the same way as I mentioned in the beginning. It's really a relationship business at the end of the day. So we pride ourselves on structuring win-win deals with mostly mom and pop owner operators. So as opposed to participating in auctions with institutional capital that has a very low cost of capital and is willing to pay some extraordinary pricing, we built that relationship. And for a lot of times, for these legacy owners, it's not always who could strike the largest check from a Wall Street operator. A lot of times it's who's going to be the best steward of the asset, because their family built it. They want to see it go into good hands. Somebody who cares about the residents, who reinvest back into the community. And we've positioned ourselves as that good steward.
So what do you see are some of these common mistakes that these mom and pop operators do where you can come in and make it a better organizational type functioning asset?
It just depends. So some of them do things really well. Some of them are very good at buying homes, bringing them in. Others aren't. Others are capital constrained. Others have partnership disputes where they're not really reinvesting back into the communities. Those partnership disputes could be family related. So we kind of come in and first we identify what the asset's worth. We'll provide a fair valuation. We'll buy it. And then what we'll do is we'll identify what its upside is. And that could range. It could be a function of, the occupancy is low because the ownership or the management hasn't bought homes to fill occupancy. It could be that there's a lot of deferred maintenance. The roads are in tough shape. Trees are grown over, and we'll come in and we'll invest the necessary capital, and we could bring the rents more to a market level. It could be that the water and sewer is being kind of paid for at the ownership level, and we will pass that through, and the tenants will pick up that cost, and that all falls to the bottom line. So the name of the game for us is how do we responsibly drive net operating income, because that's the magic number that allows us to make outsized distributions to our partners.
Awesome. And are you seeing in where I am in North Carolina on the East Coast over here, I'm seeing a lot of these baby boomers dying off. Sorry, baby boomers. And then the families, a lot of the kids, it's only about 40% of them want to take over the family business because they're like, I watched you unclogging toilets and doing all this stuff growing up. I don't want anything to do with that. So do you see there's like a lot of opportunity in this area?
Yeah, in fact, I would say that percentage is a lot lower than 40%.
Oh, really? Okay.
Yeah, I think the majority, when you think about this day and age, we're in an era of AI and tech. Getting in the manufactured housing business is probably not the sexiest thing to do, And a lot of these heirs or a lot of these children, I rarely see any that want to stay in the business. But just because these assets are so valuable, that the overwhelming majority want an exit. They want cash. They want to move on with their lives and do something else. It's a very management intensive business. It takes a lot of hard work, and we built the infrastructure and the team to do that. So the majority want an exit. They want to move on, and that's where we come in.
Very good. So what's an example of an operational refinement that sounds boring, but can actually move that needle like crazy?
Yeah, there's several. I think some of the key ones are, the occupancy. So in a lot of communities, we'll buy them at 60, 70, 80% occupancy. When you could take a 200 or 300 site park that is 70, 80%, and you could take it up to 90% plus, I mean, you're just generating a ton of net operating income in that instance, above and beyond the net operating income that existed when you bought the property. Another one is passing through the utility systems, the water and sewer to the residents. Another could be once you reinvest back into the community, you bring the rents more to a market level. And when you start to stack a few of these, Jen, on top of one another, it could become really compelling of what you could deliver here. I mean, in some instances, we're doubling or tripling net operating income in a relatively short period of time. Let's say the first 5 years of our ownership.
Matt, I love all of this. All right. So let's talk about the underwriting discipline that we do here. So, what assumptions do you intentionally keep conservative, where some of them you might be a little bit more flexible with?
Yeah, we're pretty conservative with our underwriting across the board. We have a bespoke financial model that we've created internally for just us here at Crystal View. And that model stress tests where you could increase the occupancy, where you could bring the rents, where your expense load is realistically going to fall. One of the big parts to this is where do you anticipate selling it from a cap rate perspective?
Okay.
How long are you going to hold it? What's your cost of capital? So all of that goes in, and we run very conservative models in terms of our exit on our cap rate. Our debt costs, we pretty much run them above what market is, just so we have a buffer in there. So if things don't go the way that we want, we've got room where we're not going to get crushed, where you have razor thin margins on a deal. So we want that conservatism in place to protect the downside, because if you do enough deals, inevitably there's going to be a couple that don't work out the way you thought.
So speaking of that, was there any hard lessons like that you had in the past that is now influences how you structure your deals today?
You're in this business long enough, you're of course going to have hard lessons. Some of them are your fault, some of them aren't your fault, but frankly, it doesn't matter if they're your fault or not. You got to figure out a way to mitigate them. You got to figure out a way how to contend with them. And I think that comes back to the value of what we do from a vertical integration standpoint. So we manage all of our own assets here at Crystal View, and we don't outsource that to a third party. So if something doesn't work out, we could really rally the team together to fix whatever those problems are. In some instances, we've taken a mobile home park and transitioned it more to an RV park because that's where the demand lied, and that worked for us. Other instances, we'll add more units where you have a really strong market. You're going to add even more units and develop more units at that particular facility. So it just depends. But I think really the key to this is when you manage your own properties, you could really control the performance a lot better than if a third party does that and you have no control.
Absolutely. So how are storage facilities different from the manufactured home communities?
Yeah, a lot of different ways. So storage, they're renting their belongings. They're storing their belongings with us, and great business, but it can very much become oversupplied. It's easy to build the storage unit. So some markets are oversupplied, and a lot of the major metros are oversupplied. And when you own in an oversupplied market, you lose your pricing power. Your ability to grow rents, your ability to grow occupancy is kind of taken from you because of the weakness within the market. Now, if you look at manufactured housing, there's virtually no new supply. And a lot of that is due to NIMBYism. So not in my backyard.
Right.
A lot of cities don't want to see mobile home parks being built.
Mine. Yep.
Yeah, there you go. So when you own an existing product, you have a moat to a certain extent within that marketplace because there's no new supply coming to market. So you have the pricing power. You have the ability to fill your vacancy, and you're competing, but you knew who you were competing with when you bought the property already. With storage, you could underwrite a deal, you could do everything perfectly, You could buy it, and the competition that you had when you bought it just went up 1.5 to 2x because of all the new supply, and you didn't account for that in your underwriting. Now what?
Right. And we just bought a beach property to short-term rent, and traveling out there, you pass a gazillion storage facilities, and not just storage units, but they also store boats and recreational vehicles and things like that. But they're a dime a dozen out there. So very good point. Interesting. So I want to get into vertically integrated, and I don't even know what this means. So explain, like I'm to a second grader, what it actually means.
Yeah, so the easy way to think about it is we're all under one roof to a certain extent. So when we manage our properties, as opposed to calling a third party saying, "Hey, I own this mobile home park, I own this storage, I own this vacation rental. Will you manage it for me? And I will pay you a fee, and I will hope and trust that you do a pretty good job. And my destiny is now in your hands.
Right.
So if you do well, I do well. If you don't, then I don't, and I relinquish that control." Here, we like to say we control our own destiny. So we're managing those properties from start to finish, frankly, because we could do it better than anyone else. We've built the systems, the infrastructure, the team to do it. It's very hard to manage these assets. And, a lot of our peers and competitors, they don't have that infrastructure in place. They don't have that team in place because it's very costly. It takes a lot of work to train these people. There's a lot of headaches involved in that. But when you outsource it, you're dependent on someone else. And we just don't want to depend on anyone else.
Are you an educator? You explain things so well, Matt. I love it. Do you run a coaching program or anything?
Not even close. I just I've been around the block a couple times, as they say.
You've done a few thousand podcasts where you have to say all the words for your acronyms and everything. So I love all of that. Thank you so much and you explain that so very well. And I am a victim of putting my trust into someone to run a 12 unit that we had, and they ran it to the ground because I put my trust into them. So what a great concept. So you talk about durable cash flowing alternatives to Wall Street, because there's many people out there doing that right now. So how should investors think about cash flow and upside, as a two-part return?
Yeah. So, your cash flow is, think about it like your cash on cash or your distribution yield.
Okay.
So you buy an asset, whether that be a mobile home park, a business, a rental house, an apartment building, really doesn't matter. You're going to have gross income, gross rents coming in. You're going to have your operating expenses. You're going to have your insurance, your property taxes, repair and maintenance, management, et cetera. And then below that, you're going to have your net operating income. From there, you have to service your debt. If you go out there and you obtain financing, you've got to pay the bank a certain interest rate. What's left after that, that's going to be your cash flow.
Right.
That you get to eat, as they say in the business, right? So we distribute that cash flow to our investors. And we typically do that on a quarterly basis. And typically we're in the 6 to 8% range, give or take, sometimes higher, sometimes right in that range, across our different funds that we offer. And then within those funds, we own 20, 30, 50 different properties. So we're pretty well diversified. And then the upside is, as you execute on your business plan, 5 years go by, 10 years go by, you've really driven that NOI up. You go and you sell that asset, or you refinance that asset into the marketplace, and you have a liquidity event. From that liquidity event, then you could make an even further distribution above and beyond the distribution yield. And that's what I would categorize as your upside.
So speaking of all that, so what is the most overlooked driver of long-term upside in these asset classes?
Yeah, I wish I could tell you there was just one thing that nobody does, and if you do it, you're going to be fabulously wealthy, but it just doesn't work that way. Because every property is different. I would say if you have a keen eye for identifying value within a property or within the market, and then you have the ability to untap that value, extract it, however that may be. Again, I mentioned, increasing occupancy, bringing rents to a market level once you reinvest, passing through utilities, just enhancing the overall curb appeal of the community. If you're successful in doing that, you could drive real value. So it's really the ability. I wouldn't say it's the one lever to pull. I would say it's more so your ability through pattern recognition to identify where the inefficiencies lie, and it's different at each property, and then have the wherewithal, the energy, and the ability to extract that value.
Wow, this is awesome. And your investors with your company, what's like an average investment that they would make?
Across the board. I mean, we've got investors that have put in north of 20 million. We've got folks that have put in $50,000 and everything in between. It's mostly retail investors, high net worth. We do have some family offices, some fund of funds, but it's regardless of who it is. If you service your partners, if you take care of them, if you treat them how you would like to be treated, that word and that brand and that reputation spreads, and it becomes easier to raise capital.
So, Matt, what is next for Crystal View Capital?
We continue to lean into this niche. We still see it as having a lot of runway left to execute.
Absolutely.
At least for the next 5 years, we see an opportunity to continue to find undervalued assets, those that are relatively performing, but they could perform better. Our team to step in, add that value, deliver great returns to our investors. We're going to launch future vehicles to do just that. Once it's played out where we really can't add any value to our investors, then we'll probably have to find a new game. But for the time being, again, we see some runway left to continue to execute. So we're going to do it.
Well said. So where can the listeners connect with you and learn more about Crystal View Capital?
Yeah, so you could visit our website, crystalviewcapital.com. You can reach out to our Director of Investor Relations at invest@crystalviewcapital.com.
Wonderful. Well, I know time is of the essence here. I want to quickly go into the second part of the podcast here, which is what makes you a badass. And I use the acronym BADASS, and the first letter is B for book. What is a book that's made a huge difference in your life?
If we're speaking financial terms, probably Think and Grow Rich by Napoleon Hill.
Yep.
Would be one that I would highly recommend. The power of a mastermind group, surrounding yourself with people that are smarter than you, sharing ideas and wisdom, and really having a vision, seeing yourself and your company in the future for what you want it to look like, because the subconscious mind doesn't know the difference between fantasy and reality.
You are so good. I could talk. I'm so disappointed. We got to cut this short because you are saying everything that I love, Matt. I love how you are expressing this. So thank you for sharing that one. All right. The first A in badass is for advice. You've given us plenty of great advice here, but what's the best piece of advice you've ever received?
I don't know. I've received a lot of good pieces of advice in my life, but I think probably think rationally. In a world of irrationality, perhaps over exuberance or pessimism, I think you got to take a step back. And I think the moral of this story is don't fall into herd-like mentality and do what everybody else is doing. Be an original thinker, have an inner scorecard of how you rate yourself rather than looking at others to be rated, and make your decisions based off of that. And I think if we all do that, it will probably be more successful, but maybe the world will be better too.
So well said. All right. The D in badass is for drive. What drives you to be successful?
It's changed. So in the beginning, the drive was survival. When you don't come from advantage, when you don't have a silver spoon, when you don't have money, you have a drive to survive and to live and to prove something to somebody who told you you couldn't be somebody or do something. Now, once you achieve a level of success, that drive changes. You're not surviving anymore once you're doing really well. I think for me now, the drive is finding somebody to give back to, something beyond myself. Because I mean, how well can one person live? You're not going to be driven to say, oh, I want 50 cars, I want this amount of planes, I want this many houses. You're going to lose your drive. So you got to, for me, and I think maybe it's different for everybody. For me, it's, I want to find somebody to give back to help them live a better life, maybe even to inspire them. And I work hard to be able to do that.
And you can't take those cars and planes with you when you go. So I love that.
Right, you can't.
Nope. All right. The second A in badass is aspiration. I'm a big goal setter. So what is a goal you are working on? Can be personal, can be business.
We have financial goals. Frankly, they're great to hit. I have personal financial goals. We have company financial goals. I'm more fired up by some of our company financial goals because it allows people in our organization to participate in that. And for me, I get lit up a lot more seeing somebody else become successful than rather than myself incrementally becoming more successful. Yes, I want to be better. Don't get me wrong. But I think there's more aspiration and excitement around me helping somebody else achieve their goals.
Absolutely. That's why you have such the coach vibe to me. So I love all of that. All right. The first S in badass is for systems. What systems do you have in place to help you achieve success?
We have a lot of operational level systems here that we've refined, standard operating procedures. I'll give you an example of one in our company. We have an investment committee meeting. So when you're looking at making an investment, rather than me kind of rolling out of bed and on a whim saying, hey, you know what, I got a good gut feeling about this. Let me wire the funds over and hopefully it works out well. What we do is that's no way to invest. What we do, and I've invested that way in the beginning of my career. But what we do today is we have a meeting. We have probably 10 individuals that I deeply respect and admire in our organization. We get together in a room. We look at a financial model. We look at that model beforehand. We read the investment memo, understand what that deal hinges on, how we're going to create value, and we poke holes in it as a team. And we have a robust, spirited dialogue. We go around the room and we say what we like, what we don't like about this deal. And it's not a unanimous vote, but I highly value through our culture, which is a meritocracy, an idea meritocracy, where everybody has a voice, everybody has a seat at the table. Going through that process makes me a better investor, helps me make more informed investment decisions, which in turn helps us deliver for our investors. So that's one example of the system that we have in place.
I love it. Well, I could talk to you all day, but we are short on time here because your time is so very valuable. But the final S in badass is for success. What does success mean to you?
I think success is doing the things that you promised yourself that you would do in your life. Doing the things that you promised God that you would do, that you promised your spouse, your kids, your business partners. It's probably not for me anyway, it's not a dollar amount that defines success. Can you look yourself in the mirror? That probably defines success even more.
Huge. Well, this has been such a great interview. It was short, concise, but you are so good at explaining things. One more time, how did the listeners find you?
Invest at crystalviewcapital.com or www.crystalviewcapital.com.
Wonderful. Well, Matt, thank you so very much for being with us today.
Thanks, Jen. I appreciate it.
Absolutely. And that is all. Thank you for listening. We'll catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.